So to make sure that there will be no way out in the future. Now we know that this is sort of impossible goal. So I actually have my plan is that I will have two questions for each of them, actually tailor-made to the experience, to their own perspective. So my very first question is actually for Raymond. What do you think about the impacts of all these regulations on your banking operations, on financial industries?
Okay. Thank you. And I think it's a great introduction and segue. I'm a Chief Operating Officer, for the organization Asia Pacific, actually the situation and the histories and all the things happening in the market are number one concern, to our organization. And by the way, we are not focusing on making profit. Okay, we focus to protect, our customers' wealth and asset. We help our customer to grow their wealth. And this is our primary objective. Of course, we got to get in all the risk measure, the operation control, the governance, and all the right things that we're going to do. And by the way, with the recent, I would say it's not recent, in these 3 years, we spend a lot of energy and investment and in recovery and resolutions planning. Okay, and activities, so that in case of any drastic situation happen, we can protect our customers' asset and so on. Okay, so going back, to your questions regarding regulations. Actually, you mentioned starting from 2008. So when I review back, I really feel that it's more than 20 years. In the last 10 years, in order to fulfill the regulations. And all the different regulations that we need to follow and so on, in the last 10 years. And I think quite a lot of them, you know them already. You're already the FATCA, the CRS, the Common Reporting Standard, Dodd-Frank, Volcker Rule, Basel Committee. Some people are saying that, in the banking industry, we are not innovative. I can tell you, we have a lot of people have a lot of innovations, particularly on the regulation side, the Basel Committee, and so on. Okay, and if I look at our organization, from the operations, perspective, we have made significant investment, in the last 10 years to fulfill these regulations. No matter from policy, from new procedures, new control, new governance, new risk management framework that we apply globally, across our organization in every country. I would say that overall speaking, we have been sharpening, our risk management. Okay, and in the various control, financial control, operation control, financial crime risk control, like other banks, in the world, that we have been doing very well. When I look back, one of the major things that we learned from there, while we execute, all these new regulations, new control, new procedures, I think the first thing come into my mind is we need expertise. Okay, and for each new regulations, and because of the nature of the regulation, or I would say the creativity and the additional control and governance we're going to put in, we need a lot of expertise. Okay, and the whole industry, in different parts will have been growing expertise in various areas. And the second thing is when we apply these regulations across the whole organization, it is not just a matter of doing the procedures, building the system, and ticking all the boxes. What I found the most important thing is to change the culture of the organization. Okay, and the culture got to be top to the bottom and get across the organization. Okay, and the most important thing across the whole organization is to understand the reason why we are applying these changes, why we are doing these regulations. And often, sometimes, we forget, while we execute, all these complicated procedures and control and so on, okay, we forget about the original objective, what we drive at, okay? So this is one of the major things that we will do, in terms of the cultural changes when we apply, these regulations and control. And of course, the second thing is we absolutely have to do a balanced way of executions. Often I find a lot of cases that when we implement, execute the regulatory control, sometimes it's a bit over, with like a pendulum that we didn't have in the past, but then when we execute, we go over, okay? And we absolutely make to drive the organization to make sure that we do it in a balanced way. Don't over-invest, don't doing it for the sake of doing it, and make sure the culture, is happening in our organization.
Thank you very much, I think, Raymond. I especially like your second point, you don't want to overdo it. In fact, the Trump administration, it's not easy not to mention Trump these days, because people tend to associate Trump with, tax policy, healthcare. In fact, Trump issued an executive order the 3rd of February, 2017, just a few days after his inauguration, asking the Treasury to review all these financial regulations that were introduced since 2008. And the Treasury Department actually has issued 2 reports, so far 2 reports, one on banking, the other actually on capital markets. So they actually lay out what they call 8 core principles. Okay, so aside from making sure there's no more need for government bailout, which is the stability of the system, they have 7 other principles or objectives. And when I looked at it, I realized that they want to make sure you and me, investors, we can build individual wealth. And they also want to make sure that corporations, they have easy access to finance so as to have economic growth. So let me just quote. The reports basically say that the regulations are not addressing any drivers of the financial crisis. Okay, this is really a strong statement. While at the same time, they're adding burdens to corporations, to businesses. The reports also blame the regulations for low returns on savings, for low returns on the financial corporations, and slow economic growth. So actually, I'd like to ask Alicia questions. There are a series of questions. So have we really addressed these drivers of financial crisis? Are we actually overdo it? Are we having over-regulation? Is it time for us to embrace deregulation? I think these are the questions for Alicia.
Okay, thank you very much for the question. I think it's a great segue from what we heard, all of this pressure, all of this work, all of this innovation to put up with regulation, all of that. But frankly speaking, I think, again, the pendulum, Hirschman pendulum is coming back. It's like we went too far, but now suddenly we realize that we should deregulate. But wait a minute, and this is what I want to point out here. This is, again, the absolutely pro-cyclical behavior of regulation that we kind of always foster, Now that the U.S. economy is at full employment, that, profits are back, banks are doing well, that's when we deregulate. We should have deregulated right after the crisis to allow banks to have space for credit. So in a way, I think there is probably a different story behind, and I'm going to focus on the U.S. first, this deregulation drive. If you think about these 7 principles, at least those beyond the overall financial stability one that you mentioned, they all start with American, American savers, American corporates, American. So to me, it's this America first again for the financial sector. And the irony of it is that if you think about when Dodd-Frank Act was introduced, 2010 officially, that was a time where the U.S. was kind of had leaned away, and we had this discussion before from even Basel II. I mean, it was basically very hesitantly moving towards that. And I think the Dodd-Frank Act basically meant that the US took hold of that international agenda to basically back Basel III, which might have been against, if you may, narrow national interest, but which was probably good for what I call an equal or a level playing field for everybody else. And I think that kind of drive at the time to bring regulation to a global order and give much more of an equal playing field was indeed what was behind, among many other things, this Dodd-Frank Act. And by basically undoing all of that, to me, what really comes to the forefront is, no, I'm going to play my own game again, and in a way that will, frankly, give a lot of comparative advantage to US banks with this new framework. So again, I think a lot is national interest. And this is not new. Regulation has for many, many years been used as another policy tool beyond this idea of, unfortunately, making very pro-cyclical, beyond the own pro-cyclicality of the financial sector. So in a way, rather than reducing that, I understand Basel, all of the Basel III framework tried with this counter-cyclical capital buffer. I come from Spain. We tried dynamic provisioning before. I mean, the idea of regulators trying to avoid pro-cyclicality is well noted. But it so happens that if we now deregulate right now, I just feel that goes against the whole purpose. So yeah, I would leave it there. Yeah.
Thank you. I mean, especially you mentioned this nationalism. In fact, one of the 8 principles is really to help American firms to be competitive vis-a-vis firms from other countries. So now, the situation in China has been rather different. We managed to have robust economic growth right after 2008. I think that was really good, right? Providing much needed economic growth for the whole world. But then 2 years ago, when we actually had the last AGD, Barbara, you still remember, there was financial turbulence coming from China and even spill over to the international arena, even forcing Federal Reserve to adjust its policy in response to financial turbulence in China. And subsequently, in the last year, we got currency depreciation, we got capital outflow, we got sort of slow economic growth. So this is the situation in China. And if you look at the financial performance of Chinese banks, it's not pretty. In fact, McKinsey has just released a report saying only 1/3 of Chinese banks actually, are adding economic value. I think, Professor Liu knows this really well. Our banks on the mainland, they have these dual objective. They want to find good projects to invest, to have economic growth. That's one objective. At the same time, they have to sort of inject money into those money-losing SOEs to maintain social stability, right? So, in fact, I realized Zhou Xiaochuan actually, I think Zhou Xiaochuan actually has a piece of article published in today's People's Daily, calling for the need to have the mechanism in place to prevent any systematic financial crisis. So I think there has been a call for one-stop regulation in China. And meanwhile, we are learning. I think it's important for us to learn the lessons in the United States. Actually, the U.S. Treasury reports mentioned that even in the U.S., despite of all these regulations, there has been fragmentation, overlap, duplication in the regulatory structure. So my question actually for Professor Liu, 3 sub-questions. Number 1, have we got it right in China? Have we got the right regulation in China? Number 2, are there anything special about China that make the whole regulation challenging? I think there are some special circumstances in China. And lastly, are there anything we can learn from the United States, so that we don't have to pay tuition again? I think these are the questions for Professor Liu. Yeah.
Thank you. I think the first question is that has China got the right level of regulatory, the rules or practices or financial regulations? My answer is that not a single country has the right level of regulation so far. Even in U.S., there's a huge debate and very controversial for quite long term about much too much or not enough. So it's pendulum is swimming back and forth, right? So, in China, I don't think we've got to the right level of the regulation and supervision right now. But I should say that in the past decade and so, the Chinese regulation and supervision upon financial industry has made great progress. And basically, it's in line with best practice internationally. And the basic philosophy never changed. That means you got to serve the real economy, and you should be cautious. And especially, your mission is to realize the optimism in reallocate the resources in China to help the market to realize that goal. And China is special because we have a huge section of state-led economy. A lot of people say this is SOEs, but it's more than that. More than that. So what I'm saying that another important mission of Chinese financial industry, they got to play the role in the proper way is to play the roles of checks and balances to those guys who are not borrowing the money in a proper way, okay? Who are not economically viable. So this is a huge mission and huge burden, a lot of work upon the shoulders of the market players and the regulators. So it's long distance for us to reach that goal, to find out the appropriate level of the regulation for China. But basically, I think China sticks to the right direction to move forward.
Mm-hmm. Well, I know that the U.S., they actually have these FSOC, Financial Stability Oversight Council. Is China going to introduce something similar as like a super agency looking after all these different aspects of the financial market so as to have sort of stability, so as to ensure, I think this is something that,
Yeah, macro prudential, the stability will be with us. That is our final goal, and it's a day in and day out efforts. And I think Governor Zhou is right to make some warnings, especially during this time, because I think the top concerns in my eyes in the year to come from outside is the normalization of the monetary policy from U.S. and followed by BOE and our EU partners, and slowly but definitely will be coming by the last quarter of next year. And the second one is the possible competitive tax cuts and its impacts upon the newly emerging markets in China. Because China is very large in trade warring and investment warring, cross-border warring, and flows. And thirdly, I think is populism and nationalism. It's a real threat against the globalizations. And China is for globalization, and we count the merits more than the shortcomings of globalizations. And the three top concerns domestically is, the three reductions. We have to do that, but it could be painful and costly. the reduction of overcapacity and reduction of the gearing ratio, and the reduction of the stock and the cost. And also we got to reduce the overall burden and the cost of operations. And that is something we already said in the explicit way. That's our top missions. But to implement that, it's key to watch and how we can maneuver in a careful way and a well-organized way. What is the sequence it is? The second concern is the real estate businesses. The real estate business along the coastlines and tier 1 cities, the market consensus is that we have already got bubbles. So how to diffuse the bubbles in the asset areas. And because the story behind that, everybody in that market, almost all people are using leveraging ratios. So, and the banks, the exposure to the real estate business is huge. And not to mention the collaterals they're using, the land or other things. The third areas, I think, is the banking proper and how we can improve our risk management culture and how we can catch up with the new things. Because China is unique, because the new things developing very fast, and especially in the retail banking business areas and the credit card businesses, I don't think the traditional banks can keep calm and still win. And if you sit over there idle and doing nothing, because the headwind and tailwind are very strong from Alibaba, from Tencent Pay, and from many others. So it's a sharing economy. It's a mobile payment era. So how can the banking industry cope up with that? This is a big issue. And also in line with market practitioners, how about the Chinese regulators and supervisors could cope up with such a new things and in line with the movement going forward. So with these two top concerns, these three top concerns, external and at home, I think still the government and the central bank led by Governor Zhou and the three regulators in financial industries are quite alert nowadays. So they don't talk about the deregulation. No. And they just want to have a carefully studying upon the practice we have done and to see how we can diffuse the risks forward.
Thank you, Professor Liu. You actually mentioned new thing. I think this is, so far we talk about regulations. Regulations is something that banks or financial industries, they have to deal with, but at the same time, they have to face the market. And I think now that in the last 10 years or so, we see the rise of mobile internet, we see the use of technology in finance. So I actually like Raymond to comment. Yeah, how does technology impact on your industry?
And I think is a good segue. Professor Liu mentioned about the regulations and the situation in China. I absolutely agree with that. So it's hard to look at the level of the regulations and all that. The fundamental that we are seeing is banking business, financial business is a regulated business. So this is our key pillar, for us to run our business. And you're absolutely correct. Professor is absolutely correct. From what we're seeing, so China, we're certainly moving in the right direction. Okay. But the latest, what I observe is, I think it's quite obvious to all of you, and I want to share with you that when we go to executions across the country, first things, the regulators among countries, I think they talk to each other more frequently than in the past. So which means that the best practices, has shared very quickly across regulators in various countries. And you call examples, on the councils, for us on the recovery resolution planning. So all this are getting more and more global. Okay, we are fortunate as a global bank, and we are exposed to different regulations in different countries. And I'm seeing all this are happening. Okay, and the second observation that we have is, compared to the past, is when the regulations nowadays come, they expect us, the banks, are very agile and nimble and can implement them very quickly, particularly in China. Okay, so you can see the speed of changes, the rate of changes, are getting much faster, across the world. Okay, and that all that we are seeing are very healthy, to the whole banking system and financial system. Again, the caveat that I keep on emphasizing and then personally highlight that as well, which I agree completely, is the cost of operations. Is the cost of implementing this control and regulations in different banks. Okay, and what we want to see is, when we design these regulations and policy, I think that the regulators, various regulators, can have a little bit, is on the operational concern or the cost, eventually driving the cost of operation to achieve the goal of this regulation. If we can close that loop, that will be, beneficial, to the society and to the various countries. So, going to the disruptions and and the things happening, in the market, particularly, in China, in India, because of mobiles, the mobile payment, and various opportunities that create from the internet side and the fintech. Okay, this company, Alibaba, last time when I visited them, they do not call themselves fintech company anymore. They call themselves techfin, technology driving, the financial business, driving banks, and so on. So, from a macro perspective, what are impacts, to the traditional bank or global banks, like us? I think, the first thing, it drives a lot of opportunities of new business models, creating new markets. Say in China, with all this invention and innovations, it offers additional opportunities to create, financial services for more people, in China, the underserved, people, the micro scale, loans and financial services. So it gives a very fast reach to a lot of new services and new business models. Okay. The second thing that impact our industry is the efficiency. Okay, the cost of running the business. Okay, and with the fintechs and electronic currency, faster payment, and all that's happening, with the market, it drive us, to create a better efficiency model, in running the business, so that we can compete or we can get as good as what this new fintech company is doing. Okay, and of course the third area it gets into is banking services will be more commoditized, more open. Okay, you will see that, let's say in UK, the open API, API banking is being launched in UK. It's very successful. It creates a lot of new businesses and new opportunity for different business, for different people, in using this kind of open services. So, in a nutshell, it will get us more competitive. Okay, it will create more intelligence. I wish intelligence, where we will know our customer more. Okay, by analyzing data, both internal data and public data. Okay, we'll be leveraged on the AI tools. I promise that I don't want to talk about AI anymore because the previous session did have a very deep discussion on that. But that creates a lot of opportunities, for us to entice the customer, for us to improve the service, and help the customer to improve their wealth, and so on. So it's great opportunities with a lot of challenges that we're going to tackle.
Great. I think, obviously technology can help us to lower down the operational costs, at the same time provide even better services to the consumers. I'd like to come back to Professor Liu, actually. Now, it's always encouraging to see China being a leader in some area. In this case, it's actually in mobile payment. I think, we are a leader in mobile internet, cashless society, So as you mentioned earlier, Alibaba, Tencent, they're really good, leading the way. I'm just curious to know, actually, perhaps you can actually have some insights, why China has been sort of ahead of U.S. to some extent in this cashless society. I was reading somewhere that in the U.S. people still like to use credit card and checks. Okay, so whereas on the mainland, even those vendors, selling vegetable or fruits, they prefer actually WeChat payment, yes, right? Yes. So that's actually the reason behind China's success in these mobile payment. But at the same time, I think it's creating these sort of competition between Tencent, Alibaba, and the traditional players, banks like ICBC, because, to some extent it's not fair, because basically you don't regulate Alibaba, Tencent in the same way as you regulate the traditional banks. So I'd like Professor Liu to share some thoughts on these, these questions.
Okay. The reason why China is outperforming its peers in realizing cashless society by, using the mobile payments and the big data and so on and so forth is that China is a large country, big country with large population, especially with the large population of the smart mobile phone users. Nowadays, we have 136 million mobile phone users, and some people have 2 phones and even 3 phones, so that's quite normal. And the total population is 1.38 billion, but the mobile phone user is 1.36 billion. So it's very close to the population size. And the transaction volume online last year we witnessed is about 1.5 trillion RMB, and every year it goes up with 20% plus, year-on-year basis ratio. And this is the first reason. The basic reason is because a lot of people are using the smartphones, so it's very easy for them to check the phones, use the apps, and to do the internet online shopping and the transactions. And the second one is that e-commerce is flourishing. We have a lot of small shopkeepers online, 6 million. I think we have 6 million for Rambo, and nowadays for Alibaba alone. And Alibaba people told me that every day there are 10,000 shopkeepers online were bust, and another 100,000 new keepers will be emerging. So it's quite balanced. The stock of the amount of shopkeepers online is always around 6 million. So this is something very, very flourishing. And so long as they are always over there, I think sooner or later, the traditional banking card payment mode will be replaced by the online. And the third one is that the innovation power is amazing from Alibaba and Tencent people and many others. The Chinese people are so quick learners, and they learn a lot of things from Amazon, from ePay, from everywhere, and it's a quick learner. So the chairman of Alibaba and Tencent, actually, they fly back and forth, between the Silicon Valley and Shanghai and Hong Kong quite often, usually once every week, and to quickly learn something from US and quickly modify what they learned and combine what they learned with the concrete practice and the customer experience and needs in China. And the last reason, I think, that is the shortcomings of the banking card payment mode. The coverage is narrow and smaller, and the cost is more expensive, and also it's a low efficiency embedded in the service, and also the Chinese small enterprises and the personal, entrepreneurs, they do not favor the credit card businesses, so everybody is using that. Even the next generation, they don't want to bank with banks anymore. My kids told me that they keep 50 Chinese bucks, and they can prolong their more than 1 month, to spend their decent life. Now, the only cash they got to pay is for parking fee. The rest will be all paid on the cell phone. So these are major driving forces behind, and I think that trend will be maintained in the future.
Great. Actually, Professor Liu's comments leads to the last question, which is for Alicia. We always reserve the last question, most difficult question, actually, for Alicia. Actually, I think now it's really about the role. See, this is AGD, this is, AGI. AGI is really about global issues, Asia perspective. And I tend to say it's emerging market perspectives, so it's not just Asia perspective, it's actually emerging market perspectives. Now, we wish to be the driver of global economic growth. It could be innovation. And we wish to provide stability to the financial system worldwide. But if you look back, if you look at the history, it seems just the opposite. Oftentimes it's the opposite. When U.S. was in recession, globally there was recession, right? And so in other words, it tends to be a trickle-down economics for U.S. or developed economy to developing economy. Now, if you look at the financial market stability, we got Asia financial crisis causing troubles to the world system. And 2 years ago, we got financial turbulence in China. So I'd like Alicia to share your thoughts. What are the ways, or is there any possibility for emerging markets to be the real driver of economic growth, to be the stability anchor for the financial system? Yeah.
Well, thanks for the question. Actually, to be frank, emerging markets have been the driver of growth for quite some time. In fact, since the early 2000s onwards, unfortunately not the last decade of 1990s because of both the Asian and the Latin American crisis, but thereafter, convergence has been the story, and therefore, growth-wise, real growth-wise, I think we are already there. Now, your question is well taken, though, because it looks at the financial aspect of it. So once we know that the emerging world is indeed the largest contributor to growth, and has been so even before the global financial crisis, because people think, okay, that's only because the US, went past, and then Europe, and then, no, it has started even earlier. But financially, though, things are different because of a very small point, which is that the US dollar happens to be the reserve currency of the world. And that's why it's different, yeah? I mean, it's hard not to have global implications if your currency happens to be held by everybody else. Mm-hmm. And that's why we don't have that convergence into, say, the emerging world being also the largest contributor to whatever financially, or not being a follower, basically, which is what you were pointing at. So why is the emerging world not yet a leader in financial issues? Again, reserve currency status. Now, of course, China has done some early steps and
internationalization,
of
yes.
course, but frankly speaking, I mean, I come from Europe, and I can tell you that many people may not know, but you just have to look at SWIFT data to realize that the euro was the country which was most settled in the world right before the European financial crisis. Only, there's only one dot there that goes above the dollar, but there was a dot, meaning it can happen. That's only settlements. Of course, we can't talk about derivatives market, where, of course, the dollar is massively more heavily traded than the euro, let alone international reserves, so really pure reserve status of the dollar. But so, of course, there is a long way to go, in other words, for emerging markets not to be influenced by US financial markets, okay? But having said that, and this I refer to some research we've done on Korea and Hong Kong, you already see, and this is quite amazing to me, that, say, Korea, just to give you the extreme example, if you look at just, simple SVR model, you look at structural vector autoregressive model, that's what we did, to look as to whether Korea's economy is more dependent or more shocked by the Fed or the BOJ, Bank of Japan. I mean, think about it. It's like, what a question. Well, we do find that it's increasingly more influenced by the Bank of Japan than by the Fed. And this was not the case 10 years ago. So it's about the same in the short run and then slightly more in the long run, Bank of Japan. And the reason is, of course, very simple, competition in third markets, yen and won. I mean, that's what it is. Mm-hmm. It's not really a financial channel. But this only brings me to the point that not yet, so emerging markets will depend on the Fed and will have this monetary policy normalization and we'll have to go through it, but it won't be as before. It won't be as before. The impact will be more muted. And just to refer to an example of why this is already the case, let alone research or anything, since the US subprime and then the European, what has happened next is basically this financial turmoil in China in the summer of 2015. And that has been, for EM, the largest event. Actually, if you look at outflows from EM, it was larger than the tapering in 2013. So it already shows that those financial flows are changing. They're becoming more regional. They're becoming more EM-driven. We're not yet there to say, we don't care about the Fed. That would be too strong. But I'm just saying it's changing because the real economy is also more interrelated, let aside the US. So if you only look at trade, again, going back to the fact that the real economy will eventually determine these financial interrelations, I just checked the data before coming, and I was shocked to see that US exports and imports from this part of the world have only gone down in the last 10 years, except for Vietnam. And they're very low even for Vietnam. So there's of the order of 8% of Vietnam's trade with the US, only. So eventually, that has to have an impact on finance. Mm-hmm. It will take time because of the reserve currency of the dollar. That's all. But, it's not going to be forever, I think.
So I think you are saying, you know, it's the real economy that drives the financial economy. Yeah.
Long term.
I know Raymond wants to comment further. You know, if you look at HSBC, I think Asia Pacific is the main driver. But absolutely right.